What is happening, investors? It is your boy Jack. I am not a financial advisor, and today we're going to be speaking about the 10 stocks that I will be keeping a close eye on next week. Now, I'm going to be completely honest, guys. There is not that much in the market that excites me right now. I'm finding it very difficult to be willing to invest into new companies. I'm just not seeing much value. Right now, all is well and good. The money printers are going brrr, and everybody's absolutely delighted. But there's always that little thought in the back of the head. What if one day the printer, in fact, don't go brr? And a lot of the growth stocks out there are very speculative to me. I mean, obviously there's a few companies out there, especially like your biotechs, your penny stocks, that could turn into a growth stock at any given stage, but it's not, relatively safe. Honestly, I was struggling to come up with companies to speak about in today's video because I don't want to just speak about the same companies every single video, even if they are my 10 favorite companies. But I also don't want to speak about companies for the sake of it. I don't want to encourage anybody to buy a company that I don't actually believe in. But after lots of planning, lots of research, I finally came to terms with what we're going to do. So we do indeed have 10 companies to cover today. So right before we get into it, can I ask you to please smash the like button? It helped me out so much. These videos usually do well. Can we hit 500 likes? If we do, that's the most likes I've ever asked for. That would be insane. I'd appreciate it so much. If you're new around here, please hit that subscribe button. We're on the final stretch to 10,000 subs, guys. I mean, it's crazy. Please help me get there. It would mean so much to me. And drop me a comment down below. Let me know what companies you are thinking about buying next week and your reasons for it. Whether it's a growth stock, a dividend stock, a spec stock, a penny stock, literally anything. I'm always very interested in hearing, genuinely. So with that being said, guys, let's just go ahead and get straight into the first company of today. So guys, the first company of today is actually Hertz. Now, I know what you're thinking. They filed bankruptcy. They're going down in value quite a lot. They're a Robinhood stock, but genuinely, I love them. Did I get you? Be honest, did I get you? Of course the first company is not Hertz. They're a horrific company. The management team has essentially said, why are you buying our shares? You do realize they're going to be worth zero. Right, the real first company of today. Okay, so the start of the video, I said that I don't want to keep speaking about the same companies, and I also don't want to speak about companies for the sake of it. So, we have 5 companies that I'm not going to go into detail on. I'm just going to touch off briefly. I made a full video speaking about these 5 companies yesterday, because these are the 5 companies that I bought this week personally. First up, we have Facebook, a company I have an entire video on, and a company who is the biggest position in my portfolio, second to none. You all know how I feel about Facebook. I love them with a dying passion. The balance sheet is beautiful. The growth prospects are beautiful. I think these guys are a buy at literally any price. We have Amazon, the 5th biggest holding in my portfolio. Amazon are the kings of online retail in the US and Europe at the very least. Another company who I'd be very happy to buy at any price and could very realistically see passing the $5,000 mark in a matter of a couple of years, all going well. One of few companies who actually benefited from the world going the way it has. Next up, we have Apple stock, okay? The 3rd biggest position in my portfolio after Facebook and Delta Airlines. And as far as FAANG stock goes, I think this is one of the ones that people are a little bit more worried about, just because, a lot of people won't have as much money for a while. They're having to close down some stores again, things of the likes. But when we think about a growth stock and we think about how much money we think that Apple could give us back under somewhat normal circumstances in another year or two, and then 5 and 10 years down the line, absolutely fantastic prospects and a great balance sheet to get through these tough times as well. Google stock, the 4th biggest position in my portfolio. I think you can all see that I absolutely love my FAANG stocks. I love these guys. I love the company. I love Google. I love YouTube. Okay, YouTube is my source of income. This is where I make money. You guys watch the ads, I get paid. When I began my investing journey, the first company I wanted to invest in was actually YouTube. And then I realized to do that, you have to go through Google. And then you look into Google and you realize they have so many incredible prospects. And a PE ratio of 29 for such a big company, for such a big tech company with so much room to expand, a fantastic balance sheet. Absolutely love Google. And then we have Microsoft, okay? The 6th biggest position on my portfolio. Where some people would buy Netflix, to have all of the FAANG stocks. Microsoft to me is my 5th FAANG stock. I know that doesn't make sense, but Microsoft is my Netflix. And if I wasn't in Delta, these 5 companies would be my 5 biggest holdings altogether. So that just goes to show how much I believe in them and in the sector as a whole. Now again, if you want more information on any of these companies, I have the video I uploaded yesterday. You can go check that one out. I also have a full video on Facebook that's 15 minutes long if you want a lot of information on Facebook in particular, my favorite company. Okay, now the first company will go a little bit more in depth in today. We're having a look at Activision Blizzard. So this is a company I've had my eye on since the crash began to happen. I'll be very honest with you, another company I'm kicking myself over. I was contemplating buying right around here. When I saw them getting very close to $50, I thought this has to be good in the long term. And if I had have picked them up at the bottom, I'd be up nearly 50% now. But look, you live and you learn. I missed out on a lot of opportunities because I was a very new investor and I was afraid of the market going down lower and lower. Lessons learned for the future. pick up more stocks when they get hammered to the ground and you believe in them and they have good fundamentals. But a company I've never actually spoken about on the channel despite having watched them for a long time. You guys probably know who Activision Blizzard are, okay? They're an American video game holding company based in Santa Monica, California. They have video games. Some absolutely massive names that I'm sure a lot of you guys have played. I have played a lot of these. Your Overwatches, World of Warcraft, one of the biggest MMORPGs of all time. I'm a little gamer nerd at heart, by the way. I absolutely love online games. Hearthstone, a game I actually still play every now and again. It's an online card game, it's a bit nerdy, but it's quite fun. Diablo, I've played the Diablos. Your Call of Duty Modern Warfare, Call of Duty Modern Warfare 2 Campaign Remastered. Lots of massive names. So these guys are in the gaming industry. Now the thing about games is people have always played video games since they've been out. I think everybody at some stage has played a video game, had a console. I have a PS4 behind me. I play on the Mac. I'm thinking about buying a gaming PC. And now competitive gaming is getting much more prominent. By 2021, the annual growth rate will be approximately 14% in the world of esports gaming. That means more people involved in the gaming world, more competitions being held, more money involved, and more money ultimately for companies like Activision. And the thing about a company like Activision is there is always a new game on the way. Call of Duty Warzone had a strong launch with over 60 million users in the first 2 months. 60 million people playing this game in 2 months. Now, the second time I heavily considered buying the stock was right around here, when they had actually made new highs. And it's another example of me missing out because I was worried that another pullback was going to happen. I was worried the stock was overvalued, and I missed out. Again, if I had bought this time, I'd be up another 15%. So I suppose the question is, do I think they're a good buy at this price? Now, ultimately, it's a tough decision to make, okay? The PE ratio is high. It's at 37.89, but I think the growth potential, if we look 5 to 10 years down the line, is absolutely insane, and these guys are a very prominent name in the gaming world. Quick look at the balance sheet, okay? Current assets just over 7 billion, total assets 19.5 billion, current liabilities 2.5 billion, and total liabilities 6.5 billion. So it is an absolutely fantastic balance sheet, and oftentimes I believe that when a balance sheet is so good, a higher PE ratio is to an extent justified. To be completely honest with you, I do think I will pick up a little bit in these guys next week. Now, it won't be a big position. I might literally pick up 2, maybe 3 shares depending on how much money I want to put into the market next week. A big reason is that I don't actually own a company like this yet. I'm not in the gaming world as of yet. The closest thing I have is Twitch, which is owned by Amazon, and obviously I'm invested in Amazon, but you know, I'm not invested as somebody as prominent as Activision. If I am to pick up a new company next week, it more than likely will be Activision. I do like the look of them. I know they're priced quite high. I know the PE ratio is quite high, but a lot of you guys probably do know I'm a very practical investor. We will see. I might hold off another week or two. We'll see what happens. But anyway, that's Activision. So another company I don't own just yet, okay? We're looking at Square. And a lot of people are speaking about Square lately. And I want to give my personal thoughts and opinions on them. First thing we see when we look at the 6-month chart, which is my favorite stock to look at right now, okay? We can see that these guys are actually up 53% from where they were 6 months ago. And from the bottom, they are up 157%. So it has been an absolutely insane rally. So if you don't know what Square is, here's a very quick breakdown. It's technology capable of aggregating merchant services and mobile payments into a single easy to use service. So essentially they have these little things that you can literally just plug into a phone that lets customers pay for things using their phone, using a card, whatever it is. So you don't need a standard card reader, you don't need a big massive till, you can just have one of these little things. Now, is the stock price justified? And is that PE ratio justified? We'll look at the balance sheet, okay? 4.39 billion current assets, 6 billion total assets, 2 billion current liabilities, and 4.2 billion total liabilities. So, very good balance sheet, considering that these guys did not get hit too hard by the virus. Now obviously earnings would have been down to an extent because not as many people would have been taking card payments, but a great balance sheet nonetheless. And they also have this service, Cash App, and it's like a Venmo or a Revolut, okay? It's a mobile payment service developed by Square Inc., allowing users to transfer money to one another using a mobile phone app. So instead of having to go put money into somebody's bank, you can just send it to them on the phone. And these apps are blowing up as of late. And in America right now, this service allows users to get their stimulus payments direct deposited through their platform, which made people get their stimulus check quicker, which made a lot more people download the app. They disclosed on its latest earnings calls that direct deposit volumes on its service grew by 3 times in April. So another actual service who benefited from the world we're in now. I'm going to be honest though, a lot of people expect these guys to be a $200 or $300 stock in the next year or two, or even a $500 stock in the next 5 to 10 years. To me right now, they're more of a stock to watch. I do most certainly 100% believe that they're going to go far past the $100 mark in a short period of time, in a couple of years. But I also think the growth has just been absolutely crazy. The PE ratio is very high. They do have a great balance sheet. They do have a great service. I hear you on that one. But I still think they could be a little bit overvalued. This month alone, we've gone up 20% in value. I mean, it's been very, very quick. I don't think this is necessarily a bad price point to buy. I really don't. I just think that there is better companies to buy right now. Because you guys know, I don't mind buying at the top. It doesn't bother me. I don't mind buying high PE ratios. I just don't have the confidence just yet. I will be keeping a close eye on them. They are added to the watch list. And I understand if people want to buy them at this price point. But I personally will be waiting. I'll be keeping a close eye on them next week or two. If I see any sort of a decent dip, even if it's, you know, fallen to $85-ish, I'll very heavily consider picking up a considerable amount of shares. So guys, 3 more companies. We're looking at Enterprise Product Partners, a company I absolutely love and I see a whole lot of growth potential in. They're a midstream natural gas and crude oil company. They have a 9.32% dividend yield, okay, and they're still down 33% from their 6-month highs, despite this lovely rally up 55%. That has not seen too many considerable dips. It's been nice and steady to the upside, but they are still down that 33+%. So I have a few oil related companies, okay, and EPD is genuinely one of my favorites. As I said, they have a 9.32% dividend yield, which is deemed to be somewhat safe. I don't think it's going to completely disappear anytime soon. So we can see the dividend safety is currently at 65, okay. If I go down a little bit, you'll see they do have an uninterrupted dividend streak of 21 years. Now that is a considerable period of time. These guys are very close to being a dividend aristocrat with over a 9% dividend yield. Now a quick look at the balance sheet, okay. Current assets, 7.7 billion. Total assets, 62.2 billion. Current liabilities, 6.9 billion. And total liabilities, 36.1 billion. So, from a long-term point of view, these guys are in a great place. And what that means is, in a short-term point of view, they can be in a great place. And look, we can see some nice growth in this company. From 2015, their current assets were at 4.3 billion, essentially. Now we're up to 7.7 billion. Total assets from 48 billion to 62 billion. Current liabilities went from 7.1 billion to 6.9 billion, and total liabilities went up about 8 billion. So in general, these guys have had a good 5 years. And if we look at the stock chart, it doesn't really reflect that. It was very sideways trading. Now again, keep in mind they have a very high dividend yield, so you would have actually ended up making a decent bit of money across these 5 years from the dividend alone. But in the short term, if they struggle, they'll be able to take on more debt, no problem whatsoever, because of those current assets, and they'll be able to get through things in the short term. And oil prices are on their way back up. We all know they briefly hit zero, and now they're back up to very close to $40 for WTI. And something I always like to point out in regards to these midstream oil related companies is coming out of the Great Recession, they went on a lovely bull run. I mean, look at that, 275% in 5 years, not even including the dividends, especially if those dividends were reinvested. Now since then there was some downwards movement. Here there was some political issues going on, and then it was just a lot of sideways trading essentially. Currently trading at a PE ratio of 9.06. I do own these guys and I do plan on buying even more of them. I just think that dividend is so nice. Definitely not a company for everybody. I personally love them. Okay, and we have one more oil related company, and we can say that these guys are still down about 25% from the recent highs. It is Chevron. You all probably know who these guys are. Oil in general as an industry has had a shaky, some companies 2 or 3 years, some companies 5 or 6 years. Now Chevron are one of my favourite safer bets, and Chevron do indeed have a 5.69% dividend yield, a 65 dividend safety, and if we have a look, a 33+ year dividend streak. So fantastic dividend streak. That dividend should be very safe, especially when we have a look at the balance sheet, okay? Current assets 28.5 billion, total assets 236 billion, current liabilities 28.2 billion, total liabilities 91.7 billion. So again, from a long-term point of view, balance sheet is very, very good, and they're going to be able to take on debt to get through any tough times that could potentially be ahead. Important to keep in mind that these guys are primarily in upstream operations. That was 77% of their 2018 earnings. And if you don't know what upstream is, it's when a company is exploring for, producing and transporting crude oil, natural gas and liquefied natural gas. So obviously when the oil crash happened, when prices went down very low, that was very bad for a company like Chevron. But if we are to see this recovery continue up, it's going to be very good for a company like Chevron. And as the world opens back up, as economies and countries open back up, oil supply and demand will somewhat come back into balance, and companies like Chevron should be back to making good money again. Now look, in regards to a growth stock, you could definitely argue that these are not a growth stock. Maybe they shouldn't be in this video, but I did want to get them in here because they are genuinely a company I absolutely love. I wanted to include them after doing EPD, because EPD in my eyes most certainly is a growth stock. It has the potential to be one. Chevron, you know what, we might not see crazy growth, but I think it's a much safer choice if you do want to try and take advantage of the oil industry that we're in now. And guys, come on, the last stock of today, Wells Fargo. I mean, I can't make a video on growth stocks without including one of my personal favourites, even if most of the world doesn't agree with me. If you want a safer bank stock that also has immense growth potential, maybe not quite as much, but very good growth potential nonetheless, have a look at JP Morgan for me. These guys are still down about 28% from the highs. They had a nice little 5-year streak going of, you know, pretty much 100%. And coming out of the Great Recession, these guys returned, let's say, 600%. Now, I do own these guys as well, and to be honest with you, I'm going to buy more of these guys before I buy more Wells Fargo, but my position in Wells Fargo right now is far bigger than JPM. I have about 2.5 times more in Wells Fargo than JP Morgan. That's why I'm just going to put a little bit more into these guys before Wells Fargo. But Wells Fargo on the 6-month chart, still down extremely close to 50%, people. I made a full video on these guys yet again, so if you want to check that out, seeing as this is the last company of the day, please do go have a look at that video. And since I have that full video, I won't go into too much detail, but it's a company that currently has a dividend yield over 7%. Now, what I will say is that dividend may not be safe. I'll be completely honest about that. But the reason I'm buying these guys isn't for the dividend, okay? It is entirely for growth. That dividend is juicy. It's a really nice bonus while it lasts, but at the end of the day, I don't care about it too much. If it disappears completely, I won't mind. Another company went on a fantastic run after the Great Recession, okay, and has been hit extremely hard because of the world we live in. And what I will say about bank stocks, I explained this in the full video, is that they're in a tough place. Until the world is somewhat back to normal, banks will struggle for a year, probably 2 years even. A lot of people might think I'm crazy investing in a company that I expect to struggle for a year or two, and I understand that thought process, but when I say I think they're struggling, it doesn't mean that I think I'll lose money or I'll be in the red for a year or two. I just think that when times get back to normal, that's when the immense growth will happen. I mean, that's when the hundreds and hundreds of percents of growth could happen. So if I can buy a company that I fully believe in, that I think will do absolutely incredibly in the long term, that has the Fed behind them, that has the US government behind them, I'm going to do it at a cheap price. So guys, that is it for today's video. And to be completely honest with you, the main companies I plan on picking up are the 5 at the start of the video. Not Hertz, Facebook, Amazon, Apple, Microsoft, and Google. They're the companies I genuinely have the absolute utmost confidence in right now. Oil is also a place I want to get a little bit more of my money. I am young, so I'm willing to go with some higher risk stocks. I do want to see some sort of an aggressive return for a short period of time at least, and that's why I love these big tech giants and I love struggling industries such as banks and oil. But each to their own. I'm not a financial advisor. I'm not telling you what to buy. I'm just sharing my thoughts and opinions. So I hope you enjoyed today's video, guys. If you did, again, please smash that like button. Can we hit 500? It helps me out so much. Subscribe if you're new around here. The rope to 10k is on. I genuinely hope you have a fantastic day and rest of your weekend. I will see you for tomorrow's video. Peace.